Started. Welcome everybody to our program, Fundamentals of Partnership Taxation. Before we begin, we have a couple of housekeeping announcements. I just want to introduce myself. I'm Michelle Weiss. I'm chair of the section. If you are interested in getting more involved in the section, if you have ideas about programming and articles and other such, please come to the next tax section meeting on July 21st from 8:30 a.m. to 9:30 a.m. It is a Zoom meeting, so hopefully you can do it in a relaxed way. We look forward to your input. I also want to remind you on July 25th, we have a social mixer event with the criminal law section and the immigration law section at the Stalking Horse. You can sign up. I believe it's $30 to come and join us and meet everybody. Also, I want to let you know that you'll receive your MCLE certificate shortly after the program. Your certificate will be stored in the BHBA Plus, our members only community. Please take a moment to complete the survey that is included with your certificate, and you'll be able to find everything in your membership profile, all your CLE credit. I also want to thank the sponsor of our section. The tax section is sponsored by the law firm of Hochman, Salkin, Tasher, Perez, PC. The Hochman, Salkin, Tasher, Perez, PC advantage is experience, an eye for innovation, and a genuine dedication to clients, their families, and their business. In addition to their national practice in civil tax and criminal tax controversies and related litigation in federal state courts, the firm is also active and successful in handling non-tax matters such as business and estate planning for high net worth individuals and closely held businesses, together with white-collar defense and commercial disputes. And now we will move on to our program on the fundamentals of partnership taxation. I want to introduce our speaker today, Layton Pace. Layton has practiced law for over 25 years in Beverly Hills and the South Bay. His practice focuses on federal and California taxation and transactions involving limited liability, companies, C corporations, S corporations, and individuals engaged in a wide spectrum of business and real estate activities. He has a lot of experience in partnership tax. He speaks frequently, and he writes many articles. He's been active in the Beverly Hills Bar Association. He's currently on the tax section executive committee. He's been active with the California State Bar and the ABA. He graduated cum laude from Hastings College of Law in San Francisco, California. And with that, Layton, take us away.
Great. Thank you so much. I appreciate the introduction. I appreciate all of you who want to spend your 4th of July week, beautiful day here in Southern California, hearing about the fundamentals of partnership taxation. Hopefully, I will stay on the concepts and kind of the broad picture issues rather than all the detailed rules. As we know, there are a lot of detailed rules.
Wait, Layton, I just one more housekeeping matter. If anyone has questions, please put them in the Q&A that you can find at the bottom of your screen, and Layton will attend to answering the questions at the end of the program. Okay, thank you.
Great. So there are two sets of materials. There's the PowerPoint that we're going to show on the screen. There also is an outline that's part of the materials. The outline has more material that can be covered in this presentation. And I highly encourage you to look at it. It's got a lot more details about the various issues I'm going to speak about. So the first question, of course, the fundamentals is, what is a partnership? So let's move the slide. Let's get to, yeah. So what is a partnership? So let's go to the next slide. So in 1997, the government put together some very taxpayer-friendly rules, which for the most part allow taxpayers to figure out how they want to be taxed. But it also introduces a lot of complexity. So for instance, a partnership for tax purposes can be a limited liability company. It can be a limited partnership. It can be a general partnership, an LLP. But if you're an LLC, you may not be a partnership. So you can't just tell from the state law classification of your entity what the tax treatment is going to be. You really need to determine what tax returns have been filed, what elections have been made. You also need to be aware of the general rule, which is that if you are a general partnership, limited partnership, or LLC, and you have more than one member, and you don't elect to be treated as a corporation, to be taxed as a corporation, then you'll default. So there's not an affirmative election for the treatment. You'll actually get into that. But any kind of analysis depends upon understanding the proper classification of the parties that are involved. And so you can't just live with the fact that someone says they're an LLC and have assurance that that'll be taxed as a partnership. You've got to do further work. So let's go on to the next issue. So the next question is, well, who's a partner? And this gets into lots of different issues, like how much of an interest does a person have? If you're a partner and you only have a 0.1% interest, is that enough? Or how about a 0.0001% interest? You know, you have a very large partnership that has millions and millions of dollars, you know, 0.001 might be quite a bit of money in there. So that's always an issue for debate. There used to be a safe harbor that was 1%. And so I always advise people, if they want to be certain, yeah, you try to have the partner have a 1% interest or more. But there's no hard, fast rule. The second issue that deals with who is a partner, that to me is a critical issue, is that almost anybody can be a partner. You can have it be a corporation, an S corporation, another partnership, almost any legal person. If you're going to be an S corporation, you have limitations on who can be an owner. Like, for instance, you can't have a partnership own an S corporation. So this makes partnerships very flexible, and that you can have foreign and domestic entities be owners and still get the partnership treatment that you want. So let's go on to the next slide. I think we just talked about this. The next slide after that. Okay, so can a partnership be formed tax-free? Did I do all those slides? Yeah, okay. So the answer is yes, if you're careful. And this is something that's it's important. For instance, you have existing businesses like a sole proprietorship, and now you want to bring in another owner. You can contribute property to that partnership, and generally that's a tax-free transaction. It's also important for partnerships where other entities like S corporations and C corporations, you don't need a particular interest in the entity in order for it to be treated as a non-recognition transaction. If you're trying to contribute property to a commencing corporation, you generally need 80% of the shareholders immediately after the transaction to own the company in order for it to be that way. So it's very hard for S corporations and C corporations to grow by having other businesses, other properties be contributed to them because you have these ownership issues. The other thing that you have to be careful on contributions of property to partnership about is what are called disguised sales. And there are lots of detailed rules about disguised sales. But for instance, if you transfer money to the partnership and the money then gave you $5 million for the property, and you said that that was treated as a capital contribution, how's that different from just selling the property to anybody else? Because the partnership ends up with property, the partner ends up with cash, and so it looks like a disguised sale. So this is an issue that has to be looked at every time property goes into an entity. But it actually is a very friendly rule, 721 of the code. It lets you put in property tax-free in most instances. So let's go on to the next slide. So this is an area I want to spend more time on. So let's go on to the next slide. What is a partnership interest? This is where the complexity comes up, because if you just own property directly, you just own a piece of real property, or you own your business, then you know that the real property, you paid money for it. It's going to have a tax basis. It's going to have a holding period. It's going to have its own tax attributes. So what happens when you put property into a partnership? Well, when you put property into a partnership, you've effectively created a new piece of property. That new piece of property is the partnership interest, because now you have a piece of property that you can sell to somebody else. It's not the real property. It's not the business inside the partnership. It's your interest, just like stock of a corporation. You're not selling the corporate assets. You're just selling the ownership interest. And so you have to keep track of that. And you have a lot of duplication of, the basis in the interest is this amount, the basis of the property inside the partnership is that amount. But the concept you need to come away with is the concept of outside basis, which is what the partner's outside basis is in the partnership interest. And you've got the inside basis, which is what the partnership's basis is in its assets. So let's go on to the next slide. This is a key attribute of partnerships, that you have what are called profits interests and capital interests. A profits interest is generally, if the entity makes money in the future, you get some share of that. This makes partnerships very flexible for trying to compensate key employees, your service people. They do not have to put up any money at all to get a share of the upside potential of the property or of the business. Now, there's an old revenue procedure that basically says you're supposed to hold this longer than 2 years. They're worried about, transitory, you have it and then you don't, which is effectively being paid. You have it, but then you immediately get bought out from it and end up with cash. So they have a 2-year requirement. The interesting issue, though, is that it's not defined. So let's go on to the next slide. So a profits interest is basically something that's not a capital interest. So you need to figure out what is a capital interest. Well, capital interest can be defined in different ways, but this revenue procedure defines it using liquidation value, which basically is that if liquidated the next day after you got a grant, would you get something? Because at that point, the partnership hasn't had a chance to make $1 for you to share in that. You'll just be getting what's currently there. And so I usually determine what's a profits interest by determining whether or not it's a capital interest first. And if you get a capital interest for services, that is taxable. So for instance, if there's $1 million in there and you get a 10% interest in $1 million, if it liquidated the next day, you would get $100,000 paid to you. Well, that's a capital interest. That's an immediate property interest paid to you. That's immediately taxable. If what you got was a 10% profits interest and there's $1 million, and then the company made 100,000, so now there was 1.1 million in there, you would get 10% of the extra 100,000. You would get your $10,000. That's a profits interest. You wouldn't share in 10% of the $1 million that was already there. So this is analysis that is done frequently. A lot of times you need to revalue the assets to determine, when you've had a grant, whether or not it's been a profits interest granted or a capital interest granted. And the difference is it taxable or not taxable? So let's go on to the next, slide. So we talked about this briefly in terms of outside basis, that you've created this other piece of property at a time that you've created this partnership. Outside basis is something that now they're wanting you to keep track of and report. It was something that wasn't kept track of for a long period of time. You really had to have your accountant do it. And a lot of audits arise for not being able to prove your basis. But basis is very important to do. Record keeping is really important. And the reason why is that outside basis fluctuates. Every year, when you have profits, it goes up. If you have distributions, it goes down. When you have losses, it goes down. And so it goes up and down, up and down, up and down. And it's important. So by the time you want to sell your interest and someone's willing to pay you something for it, you need to figure out how much is the gain on that to figure out how much is the tax liability. So it's very important to keep track of. So let's go on to the next slide. So this is another area that's a really important area and very complicated. But partnerships get to include in their outside basis a share of the partnership liabilities. That doesn't happen for a corporation or an S corporation. So for instance, you put $1,000 into a corporation, the corporation borrows $100,000. Your basis is 1,000. If that were a partnership, you would have a basis of 1,000, and then you have to figure out what would be your share of the 100,000 of borrowing. And if you're a 50% partner, then maybe your basis is now $51,000. And so that can really help in terms of trying to claim losses from the partnership, having this additional basis added to your outside basis due to the liability allocation. But the rules are relatively complex. And so, a lot of times partnership returns are done incorrectly because the accountants just don't have the underlying loan documents to really figure out how to properly do the allocations. So it's really critical that people doing the returns understand how the partnership liabilities work. So let's go on to the next slide. Partners capital count is also a very important concept. Partners capital count is supposed to keep track of how much money you have invested in the partnership. So it starts off by going up by contributions. It goes up if you have profits allocated to you. It goes down if you have monies distributed to you, and goes down if you have losses allocated to you. But at the end of the day, when you're trying to figure out who's supposed to get what, the capital counts are usually used to determine who gets that. It also, in some cases, can go negative, that you've somehow have taken more losses or more distributions than you should have, or that are actually matched by liabilities. And so you need to understand that the capital counts are an important concept that need to be looked at and maintained. It's we'll get down to it later here about targeted allocations, where sometimes they're not used very much, but they're still important to maintain. It's also worth a note here that if you sell your interest, then your successor generally takes on the seller's interest in the capital account. So let's go on to the next slide. So how is a partnership taxed? Let's go on to the next slide. This is the critical issue, which is that the entity itself is not the one that pays the taxes. All the items from the partnership get passed on through to the partners. That's why it's called a pass-through entity. Now, California imposes an $800 annual tax on LLCs and limited partnerships, and also a fee can be imposed based on the gross income of the LLC. So there can be some leakage, but generally it's the partners that pay the taxes. This is an advantage to other structures, particularly a C corporation, where the entity itself has to pay the tax at the first level on the profits, and then when there's a distribution of those profits to the partner or to the owner, then that person picks it up a second time, and so you end up having two taxes, one at the entity level and one at the owner level. A partnership doesn't do that. The partnership doesn't pay the tax. It's the partners that pick up and include those items with the rest of what they may have on their 1040 to figure out what the ultimate tax liability is. So let's go to the next slide. Part and parcel to that is that the pass-through to the partners doesn't change the character and the source. So if it's ordinary income at the partnership level, it's ordinary income to the partner. And this even includes, is it rent? Is it interest expense? What is the particular character of it? And so it's a mainstay that you make a lot of determinations at the partnership level that the partner then has to live with. They get reported on a K1 to the partner for the partner to pick up. So let's see anything else here. So let's go on to the next slide. This is another area that gets a lot of debate, and that is, can partners be partnership employees? Let's go on to the next slide. It's been a longstanding position of the government since the 60s that a partner cannot be an employee of the partnership. That the partner gets a K1, reports all the items on the K1, including guaranteed payments. A guaranteed payment is basically a payment that you get irrespective of the profits of the partnership. So, $100,000 a year, $150,000 a year, the partnership could lose money and still $150,000 a year, it gets paid to you. That shows up there. Some people have reported partners as being dual employees. So basically W-2s qualify them for certain employee benefits. It's not correct. I've been waiting for the government to actually change this longstanding position. I think it'd probably give them more revenue. If you have a W-2, you have wage withholding at source, so you don't have to have estimated payments. So the government gets more money quicker, and certain other items as employees can't be deducted that could be deducted by self-employed people. And so I've been wondering how come they've been staying with this position. It hasn't happened yet. Maybe in the next few years it will. But this is an important concept. You have a person that's been working there as an employee. You give that person a profits interest. That person's no longer just an employee. That person's now a partner. That person should stop getting W-2s and stop being reported on payroll tax returns and just get K-1s that report the amounts as guaranteed payments or otherwise. Let's go on to the next slide. Can partners share partnership items disproportionately? Let's go on to the next slide. The answer is yes. And this is a really big reason for having partnerships, because you want to have economic deals that aren't necessarily passing through economics straight up. Like if you're an S corporation and you've got two shareholders of an S corporation, they have to divide all their items 50-50. So all the income, all the expenses, everything is 50-50. In a partnership, you don't have to do that. You could give 50% of the profits to a partner who only has 5% of the capital in there. The ownership percentage of the capital doesn't have to match the distributive share coming out to the person. And you could even have multiple properties, and partners would share profits and losses 50-50 in one property, but maybe 80-20 on another property, because one partner is doing all the work on it, or put up most of the capital attributable to it or whatever. So it's very flexible. Partnerships are very flexible to meet your economic deal, which I think is what you need to have a successful business. The Internal Revenue Code says that for allocations and agreements, the allocations have to have substantial economic effect. This has caused the government to issue regulations that are very complicated and long, and have resulted in many pages in operating agreements and partnership agreements to try to get the allocations to be respected. But the upshot is that what it's trying to do is match up to where if you get $1 of profit allocated to you from the partnership, that's supposed to mean that you're entitled to an extra $1, that your capital account go up by $1, and you're supposed to get it. If you have $1 loss allocation, then you're supposed to literally not get one more $1. So you put $1,000 in there and you have $1 of loss, you're supposed to get $999. And if you still get your 1,000, then the question is whether that loss allocation to you had economic effect. So let's go on to the next page. So this is the allocation safe harbor that most people have seen and heard. It's certainly seen it in the operating agreements and the partnership agreements. The last requirement that partners have negative capital accounts, they have to restore them. There's an alternative rule that's in there. It's called a qualified income offset. You have a limitation on losses. So anybody who's seen an operating agreement or partnership agreement has probably seen this language in here. Let's go on to the next slide. Because the rules are very complicated and because they really require drafters and accountants to keep track of the capital accounts to meet the safe harbors, many people, really in the last 20 years or so, have kind of gone away from the safe harbor and basically say that money should be distributed in accordance with percentages and tiers, waterfall amounts, to get people the right economics, because sometimes they'll flip. You make so much money, we'll share 30-70. You make less money, we'll share 50-50. And so you've got different tiers about when the money's going to go out and who's entitled to receive it. And so these are probably the more current form of documents. The bad news is, even though the IRS has been asked and has had on their business plan at some time to weigh in on whether or not these targeted allocations are to be respected, the government really hasn't said anything. And so you're left to glean from the silence, what does that mean? Will they come in and tackle these at some point in time, or have they essentially blessed them because now they've kind of taken over a big chunk of the mainstay of partnership tax law. So it'd be interesting to see in the future how these issues work out. So if you're conservative, you follow the safe harbors. If you're really concerned about people getting their economics and you have sophisticated economic plans, then targeted allocations may be better. But you've got to run the risk of the government coming in the future, maybe not liking them. So let's go on to the next one. So partnerships, because you get to include your shared partnership liabilities in your outside tax basis, that means that the partnership can borrow money and losses actually flow through to the partner that really are attributable to the borrowed money. And so the partner gets those. The government says, well, that's really kind of not really your money. So you have a whole set of rules here that limit your ability to claim those losses, even if they're properly applicable to you. One is you have to have enough basis in your partnership interest. And you've got these other rules that people have probably seen or heard if you've done returns or even your own return, at-risk rules, passive activity loss rules, net operating losses, etc. So the good news is that partnerships are flexible, that allow you to have losses flow through, even those that are basically attributable to borrowing by the partnership. But there are other rules that prevent you from fully using those losses on a current basis, and maybe they carry forward until the partnership sells assets, or you otherwise you sell your interest in the partnership, etc. Other events. So let's go on to the next one. Can a partnership distribute property tax free? Let's go on to the next slide. Answer is yes. This is, again, a really great reason to have a partnership. If you did a choice of entity between a partnership and an S corporation or a C corporation, you would pick partnerships for this reason, because a lot of times you'll put property in there, or you buy 2 or 3 or 4 properties. One partner wants to leave. So what do you give that partner? And in a partnership, you can generally distribute property to that partner for that partner to go away. Or let's just say you have two properties in there, but a lender won't let you borrow because you have 2 properties in there. So you've got to get one property out of the entity into another entity so you can borrow against the other property. In a partnership, you can generally do it. You can generally take out property and not pay an immediate tax on the appreciation in the property. Now, you can have problems if you get cash in excess of basis, and there are other issues too. Partnerships have been used for tax abusive tax shelters for a long period of time. Really, the 80s were the heyday. And of course, that has then led to a whole series of code sections enacted during a lot of in the 90s, trying to curtail a lot of abuses done by partnerships, including putting property in and having that property then go out to other people. And so you got to really be careful. You know, the sky sale rules are part of that too. You got to really be careful about having these distributions. You also have these rules that they don't want you. The partnership has assets that give rise to capital gain, and they have assets that give rise to ordinary income. Ordinary income, of course, gets taxed to higher rates. They don't want partners deciding that one partner can pick up all the ordinary income because the person has losses from other sources, and the other person picks up capital gains, but the other person has a bunch of capital losses. They don't like you playing around with the partnership assets that ultimately cost the federal government money. And so there are limitations that require you to keep properties in there for a certain period of time, like a 7-year period of time, to prevent there from being a shifting of gains and losses. And there are other rules that treat you as having received some of these hot assets that are ordinary income. And so, you know, it's great as a general rule, but I've just spent the last few minutes telling you there are lots of exceptions. Let's go on to the next slide. So liquidating distributions are treated much as non-liquidating distributions are. And the difference is that in liquidating distribution, the partnership basically goes away. And non-liquidating distribution, the partnership's still there. The other difference here, though, is that a partner in a liquidating distribution can recognize a loss. This happens when the person gets cash distributed, and that cash exceeds or is less than the person's outside basis. That would trigger a loss. Let's go on to the next slide. This is another kind of a special rule that deals with liquidating payments. And this is a liquidation of a partnership interest as distinct from the liquidation of the partnership itself. So the partnership continues on, but the partner is gone. The Internal Revenue Code calls it a retirement, which I always scratch my head going, I don't know if this partner is retiring or not, but he's definitely retiring from that partnership. And so that's how you have to look at it. But they basically split the payments that come out of the partnership as payments that are either for the partner's interest in partnership property, just generally, you know, the amount of the person's capital account, you know, he put money in, put property in, and now he's getting that back out to him. It's kind of like the capital investment piece of it. And other payments that are for the partner's distributive share of profit or guaranteed payments. These can be like, you know, they've earned money but not collected it yet, or they feel like the person is still contributing in terms of his name or reputation. And so even though the person's out and gone, the person might be owed payments in the future for future business because they're still using attributes of that person having been a partner of the partnership to make money. So they've agreed that when the person goes away, that they're going to pay him additional monies in future years. So this is an area that, again, has a lot of nuances to it and needs to be looked at, needs to be addressed in partnership agreements. The point that the last sentence here makes that I think is an important point is that when you have a two-person partnership and one person retires, if that person is still owed money from the partnership, then the partnership continues on. And even if it's not a two-person, if you have a 3-person or a 10-person, if you have a person who's still owed money, that person is still a partner of the partnership, not for or not for state law purposes, but for tax purposes. That person's still getting a K1. That's going to show that person still owed capital or still owed other amounts in the future. It can be very confusing because you basically have signed a document saying you're out and gone, but yet you're still a partner getting K1s because you're still owed money from the partnership. Next slide. So what is the treatment of a sale of a partnership interest? Next slide. So generally a partnership interest is a capital asset, meaning that you're normally going to get capital gain treatment when you sell it. And the gain is, of course, the difference between what you get and what your outside tax basis is and the interest. However, these rules are altered if the partnership has inside assets, they're called hot assets, that would give rise to ordinary income if collected or sold, like inventory or receivables for, if you've provided goods and services, they haven't been paid yet, they're still there to be paid. So now you're selling your interest, but part of it, if it had been picked up in income, you would have had ordinary income on it. You have to bifurcate the sale. You have to basically look inside the entity. So even though you have a partnership interest, it's a separate piece of property that has this outside basis, you still have to look at what's inside the partnership to determine what is the tax treatment of the sale. And do I have any of these hot assets in there that make me have to split up the sale proceeds to determine, do I have ordinary income or capital gain on the sale? This is a distinct disadvantage from a corporation. If you have an S corporation or a C corporation and you're selling an interest in it, then that interest, as long as you've held it, it's, as a capital asset, which is basically for investment purposes, and you've held it for longer than a year, which is the long-term holding period, you're going to qualify for the 20% federal long-term capital gains rate. And you'll have to look inside to see whether or not the corporation has a lot of inventory or lots of receivables that haven't been collected and picked up in income. And so again, this is a disadvantage of a partnership. They apply what's basically called the aggregate theory rather than the entity theory of partnerships. So let's go on to the next slide. So can or must a partnership adjust the tax basis of its assets at certain times? Let's go on to the next slide. The answer is it can, and sometimes it must. And this is another really big factor. This is a reason why in choice of entity analysis, why partnerships are highly advantageous. So if you die under current law, you get to step up the assets for income tax purposes to the fair market value on date of death. If you don't make this selection, or you have an S corporation or a C corporation, what that means is the interest, the outside outside tax basis steps up to fair market value, but the assets inside the partnership has its own assets inside, the real property and the business in there, or the corporation has its own assets inside. And you cannot just start depreciating and taking your basis step up. So let's just say you've got an asset that's worth $1 million, and you're a 50% partner. So you normally say, 500,000 is my fair market value of my basis, and I die. So I got a 500,000 new step up basis because of death. But the asset inside, let's just say I only paid 100 for it. So I've got this big gain still inside the entity. So if I were going to sell the asset at the entity level, I'm gonna have a big gain. And so what the 754 election does for a partnership is it takes the step up on the outside and it puts it inside. So now the property inside is now takes on, I get the $1 million of the fair market value of the property inside. And so I now get to treat this, the heirs of the trust who take over the partnership, I get to treat it as if I've just bought a new piece of property. I now get to amortize that piece of property. And so I get to take the depreciation deductions. And if I have the entity sell the property, I'm not going to have a further gain or loss. If it was sold the next day for that fair market value, I'm not going to have a further gain or loss. So if I'm a purchaser of a partnership interest, this is great, because if I just buy stock, I can't write it off. I can't use bonus depreciation. I can't do anything to recover for tax purposes, recover my purchase price. But I can do that if I make the 754 election. And so I now effectively get to, present value my cash flows. I get to have tax savings from this additional write-off, and that's going to actually recover more quickly the investment I made to buy the interest. So it's a really, really big factor, and partnerships have it, but S corporations and C corporations do not. Let's go on to the next slide. So until 2004, these elections were optional. The 754 elections were optional, because it would hurt you that if you if you bought a piece of property in a partnership for $1 million and it declined in value to 500,000, and you had a death or you had a sale, you wouldn't want to have a 754 election in effect, because it would step down the fair market value of the property from or the base of the property from $1 million down to 500,000. And so you lose the other depreciation, you lose the ability to claim losses when you sold it. And so the government said, if you have basically a $250,000 built-in loss in the partnership, you have to adjust the basis of the asset, even if you don't make a voluntary 754 election. So they make you have mandatory basis step downs. So this is can be detrimental. You have to basically value the assets of the partnership when you have these transactions to determine whether or not I have these built-in losses and whether I'm going to have to make these mandatory adjustments. Next slide. So when does a partnership terminate? Next slide. Up until 2017, there was a rule that said that if you had 50% or more of your partnership interests in capital and profits transfer interest, you automatically terminated. You technically terminated. Well, that rule has since been repealed. So now you revert back to the other prong of the rule, which is that partnership basically terminates when it ceases its activities and has no assets. And there are questions about, well, how many assets do I have to have? Is it $1, $10, or how much activity do I have to keep it alive? But this is a general rule. But the government's concerned that there are abuses going on, that you basically have people buying out all the partnership interests, either 99.9 or 100%, and they're not treating it as really a new partnership, a new asset sale. At least that's what I think that these new rules are going to get at. And so they're going to come out with new guidance as to when, in fact, when you've had sales and exchanges of partnership interests, you've actually had you've had a termination of the partnership as well. Now, a termination has the main consequence of all the elections wiped clean. You have a brand new entity, and I would say you'd probably even get a new EIN number. Final return needs to be filed. New return needs to come up. So we'll see what they end up coming up with. Now, also, a partnership will terminate if it only has one partner. And this can be a little confusing because back to the check the box rules, which is the first slide, they have these classification rules, and you can have a partnership that a state law has, like a limited liability company being the general partner, and you have a person be the limited partner. Well, if the LLC is a is a single member LLC, or became a single member LLC, it's probably a better example, then now all my that partner gets disregarded, and that partner then that interest is treated as the limited partner interest, and I only have one partner. So you can't just look at the documents and say, I've got more than one partner at state law under the agreement. You have to determine whether or not the partners are regarded for tax purposes. So let's go on to the next slide. Can a partnership merge with another partnership or divide? Let's go on to the next slide. The answer is yes. In fact, this to me is another great reason to have a partnership. It kind of goes along with being able to distribute property in liquidated and non-liquidating distributions and not pay taxes on it. But a lot of times you'll have an idea, it'll work. That idea will spin off other ideas. Let's just say it's a restaurant, and so you're serving food, but the restaurant's a great idea, and so now you have like a name. You now have things to sell along with the restaurant. You take it. You want to now merchandise the food out to grocery stores. And so you may not want all that done in the same partnership that just initially ran the sit-down restaurant. This enables you to, these rules, to break up the existing partnership into other partnerships, or you want to acquire another restaurant to add on to your restaurant, and it's a partnership too. So you can put the two of them together and generally do it on a tax-free basis. So it's very flexible in that regard. You can see that there are certain limitations on you have to have certain requirements for ownership in order for this to work. And then you have to keep track of who's filed what returns using what identification numbers and how it's disclosed. But it's still a very favorable attribute of partnerships to be able to divide and break up. So you maybe have A, B, C, and D, and after 2 years, C and D want to do something else. Well, they take out certain assets, and so now you have AB partnership and CD partnership, and you can generally do that on a tax-free basis. So let's go on to the next slide. So what partnerships cannot do is they cannot use the corporate reorganization rules, or it's like A reorgs, B reorgs, C reorgs. Those are really for corporations, and you can't have a partnership be a party to those reorganizations. This is a drawback. So for instance, you've got some business you want to take public. You think you need a corporation to be the vehicle to get the financing to go public. You've been running it as a limited liability company for a couple of years. How do you do this so you can get yourself situated to be acquired by another big company? And the answer is, do it sooner rather than later to convert to a corporation, which can only be done tax-free. But then you've seasoned it so that that corporation can then be acquired by another corporation and get into kind of corporate America. So it's actually a drawback of partnerships that they're for the most part foreclosed from corporate reorgs. They themselves have to become corporations before they can do it. I do want to mention one other thing I must have skipped here in the presentation. That's a really critical, a very critical piece of development in partnership tax, and that is the partnership tax audit rules. They're called the BHBA procedures or the centralized partnership audit regime. These are rules that came into place beginning in 2018. On audit for many partnerships, most partnerships, the audit happens at the partnership level. But now under these new rules, it's not the partners that take their share of the adjustment for those years and pick up that income. It's under the general rules, it's the partnership that now has to actually write the check to the government for adjustments that are arising. So it kind of turns on end the idea that partnerships are passed through entities and all the items that happen from the partnership all get reported and by the partners, and the partners are the ones that ultimately pay the taxes. Now, there are various alternatives under these new rules that will enable that so that the partners have to pay it. But literally every partnership agreement, every operating agreement needs to be revised or updated to take into account these new rules. Every sale of partnership interest needs to consider what those rules are with respect to that partnership, and whether that partner is going to have residual liability, if the partnership has to pay a tax liability. So literally any business deal with a partnership, I think, needs to take into account these new rules. So I've used up most of my time. I think I'm going to open up for questions. And I've covered a lot. I really appreciate you all staying with me on this, because it's a lot of code provisions and a lot of detailed rules.
Layton, do you want to read the questions, or you want me to read them out to you?
Why don't you read them out to me? It's probably better.
Okay, so Robert Briskin said, Layton, do not forget to mention 1061 and a profits interest.
Yeah. Okay. Well, that's a new code provision that was put in the 2017 Act. It limits the ability of people who get profits interests to immediately sell them out and claim long-term capital gain treatment. Because one of the things that a profits interest will do for you is that when you get a profits interest, if the entity then sells an asset and that is a capital gain, that would normally come through to you on your K1, and you would normally report capital gain treatment. 1061 is a code section that prevents you from selling your interest or getting gains inside that are less than 3 years old and still getting long-term capital gain treatment. So they're basically it's a hybrid rule to have these people who get profits interest to be paying taxes at higher rates.
Okay, thank you. All right, Sally Weaver asked the following question. If one of the partners renders personal services, for example, as a performer under an engagement agreement between the engager and the partnership, does the pass-through element of the taxation treatment mean that the engager has withholding obligations?
It can. You have, particularly the state of California has withholding if you're a non-resident person, because well, first of all, is the person a partner? I mean, not all sorts of people. Sometimes in the entertainment industry, they'll give you residuals and things that aren't necessarily a profits interest. So you got to kind of look at the character. But if you're getting a K1, then they've treated you as a partner. I would normally say, have you signed a partnership agreement or an operating agreement that says you are a partner? But you're getting a K1. They have withholding obligations if you're a non-resident person. Now, there are also, if you're a foreign person, you've got withholding obligations as well at the federal level. So the answer is you can have withholding if they're making distributions to you, because the taxing authorities want that money paid at the source rather than the person who's supposed to get it.
Okay. All right, thank you. And Mariana Melick has the following question. You mentioned an entity can be a partner. Would an individual partner and their business entities and their business entity be able to be partners? I think she means in a partnership. I'm guessing in the same partnership.
Yes, the answer is yes, but with the caveat that when you have these entities, you got to make sure that each entity is a regarded entity. So you can have a partnership with your corporation. You can have a partnership with your partnership if you wanted to, or your LLC. But in order to have a partnership, you need to have more than one partner. So you need to make sure that this related entity is not like a single member LLC is disregarded, because that's treated as you. So you can't have a partnership between you and your single member LLC. So the answer is yes, but you got to make sure that the entity is a regarded entity. And the government may, it depends on what else is going on there. The government, you're supposed to have a business purpose. So you've got to, I can't say with absolute certainty the government's going to like it if other transactions are occurring that are somehow looking to be abusive.
All right, thank you. And Howard Crum asks, Can you speak a little about how the partnership capital and income interests are converted when the partnership converts into a corporation?
Yeah, that's always a trick, because you kind of got to figure out if you have a capital interest, that's much easier, because you ought to then just get, whatever your percentage interest is. But if you have a really complicated distribution or economic scheme in your partnership, it can be really hard to figure out, should you get more than one class of stock, for instance. I mean, if you've got different classes of interest, are some of them like a preferred interest? And so should you just get common stock, or should you get, preferred A, preferred B as well? And that may have to happen if you're trying to convert differing interests in a partnership into a corporation, where the profits interest doesn't get necessarily the same interest that a person with a capital interest would get. So it can get complicated, depending upon just how complicated the structure is with what the partner's interests are. I hope that answered it.
Okay, all right. Well, we have one more question from Joe Hooser. It might be too much for today, but I would like to see the 754 election explained through a written example.
Yeah.
Not sure. I guess that means not an oral answer, but
Yeah.
I don't know if you want to talk about
So I'll
it.
just tell you a little bit more about it. It's complicated because you've got some that are based on transfers of the interest themselves, like death or sale of the interest. You have some of the adjustments because the partnership is distributing property, and so the adjustment can be treated differently. And then even when you determine how much the adjustment is, you have to figure out which assets inside the partnership get that adjustment. So you have to basically allocate the adjustment, because you may have 10 assets inside the partnership, and you have someone bought your interest or you died and it steps up, so you have to go through that. So 754 in itself with its adjustments can be pretty complicated. But the idea is that you're supposed to match, fundamentally, the outside basis matches the inside basis. So if you have a 500 basis in your outside interest, you should have a 500 basis in the assets inside too, spread amongst the assets of the partnership. So I hope that at least explained it a little bit more.
Okay, and the person who asked the question, I guess if you have any follow-up or you want to see something else from Layton, you can, Layton, I assume people can contact you if they have any
They can
follow-up.
contact me, and as I say, they ought to go to the outline, because the outline actually gives more details on liability allocations, much more detail on all these points.
Okay, all right, Layton, well, that wraps it up. We're just about at the hour, so that was perfect timing, so thank you.
Great.
Thank you for all that info. It's a lot to process, but we do have your materials, so really appreciate it. If you are interested in becoming more active in the section, I want to remind you that we have our monthly meeting in 2 weeks. It's a Thursday morning at 8:30 a.m. on the July 21st. And please sign up for our joint social mixer with the criminal law and immigration sections. And have a great day. Bye-bye.
Great. Thanks so much.